I'm Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. This video will explain the widow and widower tax penalty, which is an often unanticipated increase in taxes for a surviving spouse after the death of the other spouse. I'm going to explain what this penalty is, why it happens, and most importantly, what you can do to minimize it. But before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. As if losing a spouse isn't bad enough from an emotional, mental, and potentially even physical perspective, it often has adverse financial impacts too. And unfortunately, considering women usually outlive men, the financial problems related to the death of a spouse are more prevalent for women. If your spouse dies, your expenses likely won't go down significantly. Now, yes, there will be less medical expenses, less discretionary expenses, and a bit less money spent on things like food and clothing. But your payments for things like rent or mortgage, utilities, and home maintenance won't decrease much, if at all. While your total income will presumably go down after the death of your spouse, your taxes are actually likely to increase. This is the widow and widower tax penalty. Under U.S. federal tax laws, the income of married couples is taxed less than identical amounts of income for single persons. One of the reasons why is the difference in standard deductions. When calculating your taxable income, the IRS allows you to deduct certain amounts from your gross income. In 2020, the standard deduction for a married couple who file a joint tax return is $24,800. Additionally, for each spouse who is 65 or older, there's an extra $1,300 of standard deduction. All said and done, for a retired couple who are both 65 or older, the standard deduction would be $27,400 in 2020. On the other hand, for a single person, the 2020 standard deduction is only $12,400. The extra deduction if you're 65 or older is $1,650. Combined, a single retiree age 65 or older would have a standard deduction of only $14,050 in 2020. As you can see, the standard deduction is more than $13,000 larger for a married couple than for a single person. In addition to larger standard deductions, married couples also benefit from larger tax brackets. Here are the federal income tax brackets for 2020. Both married and single persons have the same brackets ranging from 10% to 37%. However, with the exception of the highest bracket of 37%, the amount of income under each bracket is twice as large for married couples as it is for a single person. All else equal, that means a given level of taxable income for a married couple will have less tax than for a single person. When your spouse dies, the IRS allows you to file your taxes as married filing jointly in the year of your spouse's death, even if your spouse died in the beginning of the year. But starting in the year after your spouse's death, unless you remarry, you'll have to file as single, not married. This means your standard deduction and size of your tax brackets will decrease, which means your effective tax rate will increase. There are a few exceptions that will allow you to file taxes as something other than single, and doing so can help reduce or at least prolong the increase in taxes. Specifically, there are filing statuses called head of household and qualifying widow or widower. But in both of these cases, you need to be paying and caring for children and or other dependents. In the case of most retirees, these exceptions will unfortunately not apply. Let's walk through an example of the widow and widower tax penalty. This will show the income and taxes before and after the death of a spouse. Our fictional married couple are John, age 75, and Jane, age 72. John was the primary breadwinner for most of their marriage. Jane spent the majority of her adult years raising the family, but entered the workforce later in life. First, let's see their income and taxes while John is alive. John receives annual Social Security benefits of $30,000. Jane's Social Security is $18,000. John also has a pension of $30,000 per year. John and Jane both have individual retirement accounts or IRAs, and because they're both 72 or older, they are required to take distributions known as required minimum distributions or RMDs each year. I'm assuming John's IRA is $600,000. Since he's 75, he'll need to withdraw about $26,400 this year. Jane has an IRA of about $100,000. Her RMD this year is roughly $3,900. To learn more about RMDs, check out my other video, Understanding Required Minimum Distributions. In total, John and Jane would have $108,300 of income this year, and using 2020 standard deductions and tax brackets, they'd have to pay total federal tax of $8,384, which is about 7.7% of their total income. Now let's assume John unfortunately dies and Jane will have to file as single. Let's see what happens. John's Social Security stops, but due to the way survivor benefits work under Social Security, Jane's own benefit essentially goes away and she starts to receive the higher benefit John was getting at the time he passed. This means Jane loses her $18,000 benefit and instead starts receiving a $30,000 per year survivor benefit. As for John's pension, he elected a payment that would continue to Jane if he were to die first. Therefore, Jane will continue receiving his $30,000 a year pension. With regards to John's $600,000 IRA, it was transferred to Jane upon John's death, and Jane was able to put it into her own IRA. So now, in addition to the $100,000 she already had, Jane now has $600,000 more, or $700,000 in total, in her IRA. Since she's 72, her RMD on that IRA would be about $27,300. Combined between her Social Security, survivor benefits, John's pension, and her required IRA distribution, Jane would have $87,300 of total income. As a single taxpayer, her 2020 federal tax would be $10,992, which is about 12.6% of her total income. This is the widow and widower tax penalty. Jane now has about $21,000 less of income, but $2,608 more in taxes. Keep in mind this is just federal income taxes I'm showing here. Depending on what state she lives in, Jane's state income taxes are likely to increase as well. Also, in addition to standard deductions and federal tax bracket sizes decreasing, there could be other additional retirement-specific taxes that come into play upon the death of a spouse. For example, more of her Social Security may get taxed and her Medicare premiums may increase. For more information about these additional taxes, check out my other video, Hidden Taxes in Retirement. So now that you know about the widow and widower tax penalty, what can you do about it? First and foremost, it's important to be aware of its existence and how it may impact you. When planning for retirement, whether you work with a retirement planning professional or do your own financial planning, you need to account for the death of your spouse as one of the what-ifs in your retirement plan. This is especially true for women, as I mentioned before. While there is no silver bullet to avoid the widow and widower tax penalty, there are some things to do to lessen its impact. And all these things basically involve managing and ideally reducing your taxable income in retirement. One of the best ways to do this is to plan ahead and put more of your retirement savings in Roth accounts instead of tax-deferred accounts like traditional 401ks and IRAs. Even if you're already in retirement, you can convert some of your tax-deferred monies to Roth accounts to help lessen your future tax burden and the impacts of the widow and widower tax penalty. There are other ways to reduce taxable income, such as making withdrawals from cash value life insurance or tapping your home equity as opposed to pulling money from IRAs or 401ks if possible. There's a lot more to effective retirement tax planning than what I mentioned here, but these are at least things to keep in mind and things to further consider. Well, that's it for the widow and widower tax penalty. I hope you found it informative. If you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes in Retirement, where you can get answers to all your retirement-related tax questions. Thanks for watching. I'll see you soon.